You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, markets have been volatile. Are they going up? Are they going down? What about inflation? Is it really going to get bad, even worse than it is now? And how about that negative GDP print? Will that get worse and worse and worse? Well, it all doesn't really matter. It's what effect it has upon you, your investments, your financial situation. Here to give us some insight is our good friend from macrotides.com, Jim Welsh. Jim, great to have you back on. So the market...
Always good to talk to you. Always good to talk to you, Kerry. Thanks.
Hey, well, so you too. And the market, higher, lower? Is this just a dead cat bounce? What's your take?
Well, my take going into this year, I thought there would be a 10 to 15% pullback because the Fed was going to shift away from, extreme accommodation and begin to remove some of that accommodation. We'd see price earnings ratios, especially on the tech stocks, start to compress. The Fibonacci retracement that I talked about from early April when the S&P was up near 4,600 was 3850. The actual number was 3815. As we know, the S&P got down to 3810. When it was down there on May 20th, I said, look for a rally that takes the S&P up to 4150 to 4200. The high last week was 4178. We're kind of at a crossroads, Kerry, in that you have three waves up, and we need to see we've had the pullback from those highs. We need to see the S&P punch above 4,200, and then potentially that would open the door for even higher prices. But this is the Fed is at a very interesting juncture, and that will play a very significant role over the next couple months.
Hey, so what is the Fed going to do? What can they do here, really? I mean, like inflation's here. It's booming. These interest rate increases have had a real adverse effect on the market, the economy, and housing. How much more can they do before everything blows up?
Well, I'm not quite as negative, only because consumers still have over $2 trillion worth of savings. Now, the bottom 20% of wage earners are really getting squeezed fairly significantly because they spend far more. I've discussed this the last couple of months. You add food, energy, and shelter, and the bottom 20% will spend 70 to 75% of the disposable income. We obviously all know what's happened with gas prices. Food prices are up 11%, and rents are up 15%. So the bottom, as you go from the bottom up, the squeeze is already very, very intense, and that's going to continue. But the fact is, there is an awful lot of savings that are still available that I think helps cushion. In addition, wage growth, 5 to 6% based on last week's employment report. Yeah, it's not keeping up with inflation, but people aren't at a point, Kerry, where they're going to just turn off the spigot and stop spending overnight. So those are the reasons why I still believe there's a decent chance that no recession this year and potentially no recession next year. To me, the dividing point is whether or not the Fed has to go above 2.5% on the federal funds rate. So, my take is they are going to go 50 in June, 50 in July. And what they've tried to do is keep the markets from getting ahead of them, because Bostic from Atlanta is not a voting member either this year or next. He said, well, I might consider a change in September. Well, one has to know who's saying things, and then how quickly do other members of the Fed come out either for or against what somebody said. And we saw this a few months ago when Bullard back in February said, I'm for a 75 basis point hike in March. The blowback was immediate. Same thing happened last week. Waller, who's on the board of governors, so they get to vote every single meeting forever. His comment was, no, we need to keep raising rates. So I think, Kerry, we're at that point where they don't want the markets to think that they may not do it in September. And so they're going to push back against that. But in my opinion, the reality is they're waiting for data. And if we see more improvement on inflation coming down, I think there's modest improvement that's going to be announced this Friday from May because of gas prices and oil prices that comprise 8% of the CPI. They were up 11% in the month of May. So they're going to add a lot to the inflation while other categories come down. So the bottom line is, I think the Fed is still going to be raising 50 basis points in June. I think the statement's going to be pretty hawkish. I think Powell's going to be pretty hawkish and keep sounding that, hey, inflation's a big problem, but we're here and we're going to take care of it. I again, like I said, I think as they raise rates a little bit more, the economy is definitely going to show more signs of slowing in coming months. But that pool of savings should act as a cushion, at least for a while.
The pool of liquidity that they created during the pandemic, a lot of it's still out there, isn't it?
Yeah, it is. And, that's the other issue that hasn't been getting as much attention and should and deserves attention is the Fed has started to shrink its balance sheet. I've discussed this in the last couple of months. If you look at what happened in 2018, the market struggled with that. So that withdrawal of liquidity, is a headwind. There's just no other way about it. And no one knows, including the Fed, what the full implication will be. Can they ramp it up in 3 months to $95 billion a month, or they're going to have to make a change on that? They don't know, so we don't know either.
We have a good idea. That reminds me of that radio show, The Shadow. Knows what evil lurks in the hearts of the Fed. The Shadow does, right? You remember that, huh?
I do.
Back too far for you, right?
No, I wish you were. I wish you were, Kerry. Actually, no, I do remember that.
Yeah, I've only heard the replays. You might have been there for the real thing there.
All right, don't date me too much. Don't date me too much.
Probably not the real one, but you know what I'm saying.
I know, I do.
Who knows what inflation lurks in the hearts of the market, right?
Yeah.
The Fed do. The Fed
does, yeah. Right? Yeah, they think they do. I mean, again, this is a group that I wrote about this last month, that if you looked at their projections for the federal funds rate, GDP, unemployment, inflation.
They've been wrong about everything.
2/3 of the time they're wrong about where the Fed funds rate is going to be. Okay, so
they said it, and they're the ones that said
it. And they have control over it.
Yeah,
it's one thing to be wrong about inflation or the economy. They don't control that, but they do control the federal funds rate. So, yeah, their batting average is not something I would bank on.
Yeah, well, I don't trust them because they're the kind of person, the kind of parent forgets to give their kid medication for like 3 days. And then they come back, say, oh, my God, I haven't given them anything. And they give them all 3 days worth of a dose, plus the day they're supposed to be giving it to them all at once. And then they can't figure out why the kid's in a coma.
Right.
They're like negligent paternal figures at best. On their best day, and on their worst day, they're downright destructive.
Yeah, no, I mean, if you look at the inflation rates going back 200 years, and you can find these charts, and the Fed started in 1913. And you look at what's happened to the pricing levels, and I've criticized them. They have a target, and so do other southern banks. They want to target 2% inflation, like that's stable prices. The average person lives almost 80 years. Well, prices double at 2% every 36 years. So that means in the course of somebody's life, according to the Fed, a period of stable prices, the cost of living would quadruple. So I agree with you, Kerry, that, to me, their goals and stuff are just stupid sometimes in terms of what they think is the right thing. And I think, I did a piece recently where I think when we get closer to 2025, and it may happen sooner, but I think we're on the cusp of a 15 to 20-year bear market, similar to what happened between 1966 and 1982, because there's a lot of issues that have been building within the U.S. economy and society that I think are going to come to a head. And it takes time to work through really big problems, and monetary policy, the level of debt. These are all big time problems. The birth rate is really low. So labor market growth is going to be really pathetic. GDP growth, even on if we have a number of good years, probably won't exceed 2%. So there's a lot of things that are coming due. I just think there's the potential that over the next year or two, potentially the S&P has one more move up to a new all-time high before the rally from 2009 is over, the rally from 1982 is over, and potentially the rally from 1932 is over.
Oh, I thought that was over for a while.
Well, we're still making new highs. Okay. Yeah, I know. Yeah, right. Well, it has been, but all good things come to an end, You know what? So
I'm going to party like it's 1899 in that case.
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million-ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well-positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, let's see. You'll have to go through the 1903 recession, 1907 financial crisis, which actually sowed the seeds for the birth of the Federal Reserve in 1913. Yeah.
Yes.
They got tired of relying on J.P. Morgan to save the day.
Yeah, well, that was bad PR. Bad PR relying on J.P. Morgan, and like he had his reasons for it, obviously, but I don't know if this way is going to last much better in the long run. But we will see, I guess. So sectors, what sectors should we be looking at? What are going to do the best?
Well, again, I still think, okay, there's, like I said, we're coming to a crossroads here. I think there's the potential that we're ultimately going to see another drop below 38.10, the low. But over the next month or two, there's the potential that the S&P can maybe get up towards 4,400. And then a lot of things will have to go right to go to a new all-time high. Some of the issues that are outside the Fed's control, obviously COVID, computer chips, labor market tightness starting to ease, supply chain issues. If those things start to help, as opposed to impinge on what the Fed has been trying to do, then I think there's potential for a new all-time high. And so I'm not trying to be equivocal, because normally I don't think I am, but we're at kind of a key point here in terms of what the Fed is going to be forced to do. I think inflation is just the mathematics. When you take away big numbers from April, May, and June of last year, it's a high hurdle rate for the current months to exceed. So you have some of that going on. And I just think inflation is going to downtick over the next handful of months. But it's really a question, Kerry, is it downticking enough to give a number of the people on the Federal Reserve confidence that it's going to continue to trend down? And quite honestly, I don't know. They don't know. That's why I think they're data dependent. And that's why I think they want to keep the potential of a 50 basis point hike in September on the table. They don't want to take it off. they just want to keep that out there. So in terms of markets, the dollar, I think, has been pretty strong. I'm looking for a pullback to the 99.50 area. Gold has been under pressure. It needs to hold recent lows in order for it to make another run above 1900. It's just, I don't have a clear line of sight at this point on any sector where I can pound the table with a high degree of conviction. When volatility increases, the correlation between different sectors begins to move upward towards one. In other words, they all move, to some degree, pretty much together. Mm-hmm. So it is noteworthy, I think, that last week OPEC said, yep, we'll increase our amount of oil from 430,000 barrels to, I think it was around 650. Oil prices went up. So that, I think we really need to see a break in oil and then obviously subsequently gasoline prices. And we're heading into, a seasonal period of time where the demand, especially for gasoline, is really high. So I just think that you have to be head on a swivel and run from there.
All right.
It's that simple.
I'll just point out a couple of things here. Number one, I think even the price of oil isn't really what we should be focusing on. We should be focusing on the price of natural gas, which from its low several years back has
$1.60.
Yeah, $1.60. It's only up a little more than fivefold.
100%.
All right. And from a year ago, it was trading at $3.50, so it's only up to 9 something. And the economy is much more natural gas dependent than few people really care to think about. This is like a big deal here, is what I'm saying. Yeah, no, and it hasn't gotten enough attention because back 30, 40 years ago, we had these long-term take-or-pay gas contracts, and they were fixed price. They might have provided for a little bit of increase over time, but what that did was it ensured the stability of nat gas prices. Those contracts have been basically eliminated. We go out 3 to 5 years at the most on these contracts now, and even a lot less than that. And then they rely upon hedging in the futures markets to try to lock in their prices. So the impact on the economy is totally misunderstood or just not totally neglected. And it's a lot bigger because a lot of conversions have taken place from crude, from like number 2 heating oil. A lot of buildings used to heat with oil. Now they heat with nat gas. Fertilizer used to use oil as a feedstock. Now it uses nat gas. Natural gas, yeah. So there's so many things that are neglected. And this inflation in commodities prices we're having, let's call a spade, it will just continue on because it's a matter of too many dollars chasing too little energy, plus add in the Ukraine war and all that. So I don't believe that they're going to be able to control it. I think the best they can hope for is stagflation. And if they can get it down to 10%, they should pat themselves on the back and think they did a job, that it's a job well done, because we all know that the inflation rate is much closer to 20% than it is to 8% right now.
Well, I'm not sure I'd go that high, but I think your point about nat gas is spot on. And compounding everything that you went through is we're trying to ship and export more natural gas than we ever have in the past. So we're depleting supplies that maybe in the past would have gone to domestic needs, but we're doing it obviously to help Germany, which made some really, really bad choices in terms of energy. What I wrote about in the June macro tides, to your point again, is that the Biden administration has done nothing to address the energy problem, not only for today, but in coming years. I mean, they are so focused on only green energy. And so, releasing oil from the Strategic Petroleum Reserve, that's okay, because that was oil that was already drilled for, and it's sitting somewhere, but they have done nothing to increase future supplies. And the one thing I'll mention, in early April, they had a big conference about computer chip supplies and increasing domestic production. And then one of the people in the Council of Economic Advisors made a comment. Well, we're signaling that the computer chip industry is going to be working under a favorable regulatory environment. And we think that signaling then will increase domestic chip production. Well, you can't have it both ways. You can't signal to the computer chip industry, hey, we're behind you. We got your back. And in the meantime, candidate Biden said, no more drilling, no more fracking, no more development on federal land. So the signaling to the energy industry for a long time has been, we're just waiting for you to die. And we're going to try to do everything we can to expedite that. So it's extremely hypocritical. Then say, well, we'd like you to, at least in the short term, increase production while we try to strangle you longer term. So to me, unfortunately, those who are ideologues, I mean, should we cut emissions? Absolutely. Have we been doing that much better than most countries? Yes. Well, but you need to signal to companies that, all right, we're not out to kill you. We just want to move toward, a lower emission level over the next 20 to 40 years. So they're making it worse, and we're not helping Germany and other countries that have been dependent on Russia for natural gas. We're in a war, and the best thing we can do is longer term provide the energy that they need to give them independence, and it will also help their economy. But in the near term, all the things you cited plus this, there's a real floor underneath nat gas prices.
Yeah, well, it's going to be interesting. If nothing else, it's going to be interesting. Hey,
keep your head on a swivel.
Yeah, absolutely. Hey, so in any event, macrotides.com.
Yep.
Go there to the site. And hey, if you've got a question for Jim, just shoot us an email, kl@kerrylutz.com. Make sure you sign up for your free newsletter, weekly newsletter at financialsurvivalnetwork.com. I've been taking it a little easy in the summer, but we'll pick up the pace starting this week. Jim, always a pleasure. Thanks so much for stopping by.
My pleasure, Kerry, and for faithful listeners of the quality content that you provide, I'd be happy to provide at the June Macro Tides issue, which discussed a lot of the things that you and I covered briefly. So Jim Welsh Macro at Gmail, and I'll be happy to shoot you a copy as a faithful listener to Kerry's show.
Hey, thank you so much for that, Jim. We appreciate it. And hey, a link will be on the site. All right, thanks.
All right, buddy. Take care.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.